This is our Forex blog for May 22nd, 2013. And the main reason that I do this Forex blog each day is so people can basically see our software in action each day and know it works and decide to either buy it, lease it, or get it for free by opening a live account with FXCD, Forex.com, FXCM, Allpari, and so forth. So basically, this is one of the easiest ways to trade. This is our currency indexes, and I've basically compared all the dollar pairs and create a chart off of that. And so you can basically see at a glance whether it's going up, dollar's getting stronger, or down, dollar's getting weaker. You can see the previous day's high and dotted green, previous day's high, low, and dotted red. The point of control, the price that most traders had positions in all the dollar pairs in orange. The previous week's point of control in, previous week's point of control in orange, previous day's point of control in yellow. This is a price that most traders have positions in, let's say the yen index for the previous day, for the previous week. These tend to be major areas of support, and once broken, market's very likely to go the other way because stops are placed around these areas. Because if the previous day most people have positions here, if they're long, they're making money above this line, they're losing money underneath that line, most people in most yen pairs. And so when it goes from above to below, everyone who's long yesterday is now losing money. And you know that by looking at this. And therefore, stops are likely to get hit in a very close proximity to this, causing further downside price movement. It's that simple. The market's chopping around, breaks out, fails to go above the previous day's high in the Swiss. These are very predictable areas that act as resistance. And once broken, tends to cause big moves. So let's look at some of the easier trades today. The euro. It trends up. It's above its hourly moving average in orange or gray. The 15-minute moving average in green. It's going sideways right here. We have a nice, beautiful rectangle pattern. Anytime you see a 2 to 5 hour, longer the better, rectangle pattern breakout, it's very likely to work. I'd put it as high as 70%. You see the exact opposite here in the Australian. The euro has a daily and a weekly trend that's up. The Australian has a daily and weekly trend that's down. So this breaks out a little bit before, or around 3:15. This one breaks out a little bit later. But you can always buy the strong ones versus the weak ones. If one's going sideways and the other one's going up, and the longer term trend is down, it doesn't matter if this one still goes sideways against other pairs. You still want to buy it. Another one that was down is the New Zealand, because it's underneath its hourly, it's underneath last week's point of control, it's underneath yesterday's point of control. This one's kind of ambivalent. At 3 o'clock, the yen goes from above to below its point of control. So some of the higher probability, and I'd say 70 to 90% likely trades at 3 is to buy the euro yen. You don't want to buy the euro dollar, even though it may still go up, because the dollar is also above its hourly, it's above its point of control, and the daily and weekly trend don't look too bad. Ideally you want to buy the strongest one versus the weakest. So the New Zealand is clearly one of the weakest. The CAD is going sideways. You can see the weekly trends down. You can certainly buy the Euro CAD too. It's not the highest probability. And when you add up all these probabilities, it helps. So let's start with the Euro Australian. 3:30 when this thing broke out. If you look at the individual chart, you'll see it was also in a nice little rectangle pattern on this chart with a slightly higher, the lows are getting higher each time, so it's kind of a pennant pattern. Breaks out right here. You want to draw your fibs off of this to get an idea of where the fib targets are. I'm just estimating. The upper containment band is usually a pretty decent place. Perfect oscillator. Most of the time when it gets above 80, the market's very quick to get to release. So I would probably myself get in half here, make 30 to 40 pips on the first half, and then just kind of trail my stop up underneath each bar's low and get out. And if you want to do counter trend trade above the upper containment band, most of the time you're going to make 10 to 25 pips. That's why I tend to scale into trades, because the majority of times you make money above or upper containment band, especially when the perfect oscillator is at an extreme. You can see if you got short up here, it pulled back 50 pips, which is kind of a high amount, but most of the time you're going to make 20 to 50. So let's look at the euro yen at 3:30, another high probability. You can see this one was above the hourly moving average before it broke out. It had a nice little kind of trend line breakout as well, a little bit before 3 even. And the ideal trade would have been get in here and kind of put your stop right underneath the trend line off the lows for the tiniest amount of risk. The key to making money trading is all about risk management. not risking your whole account on any one trade, and taking trades where you risk a tiny amount of pips and you have a good shot of a high number of pips. Our containment bands are statistically based. A lot of times it reverses at the 1.5 red one, but the majority of the time it doesn't go much beyond the 2.0 white one. And you also have our perfect oscillator, which is completely different and uses a completely different algorithm. But typically at and above the 80 level, you're going to get reverses. And when it's above the 2.0 white band, and this happens even more so. And also oftentimes when price goes above the upper Bollinger Band and then back in it, it tends to reverse. So you can see that causes about an hour and a half kind of slowly sideways movement. But anytime you can take a trade with a very high probability of making even 2 times more than your win. If you take a trade and this is your likely profit target, it's worth taking. This one probably moved about 4.5, 5 times. So let's take a look at the last one, which I think was the CAD. It was kind of going sideways, not the highest probability. But odds are 3 o'clock, the euro going up, the CAD going sideways. This is going to be a profitable trade too. You probably would have got into it on this little flag pattern right here. And again, look where it stopped. And typically, at and above the upper band, if you want to do counter trend trades and you kind of scale into a trade a little bit progressively, and your average price is up here, when it pulls back, you make 5 to 15 pips. You draw your fibs off of this, and then you have your fib targets up here to scale into. You get into 1 lot here, for instance, 2 lots here. Your average price is right here. Usually, within 5 to 15 minutes, I'm at break even or plus. You can see this one pull back 40 pips. Now, strong trends. This is a method I haven't taught for a while in class. When you have a strong trend, one of the highest probability trades I've found is buying a 2-wave pullback. So you wait for a strong trend, preferably above or upper containment band, showing it's strong, preferably with the perfect oscillator showing 1 to 3 extremes of being over 80, and then you wait for a 2-wave pullback. This is 1 wave, and then it came up and made a double top, and then down here. And you can usually do the same thing by scaling into a trade here, a little bit light, a little bit heavier. Your average price is going to be really close to the low here. And once it starts going your way, you move it to break even quickly. And any sign of stalling, you want to get out. In this case, it went way above the plus 80 level, way above the upper containment band. And I'm going to probably get out of half my trade here and then just keep scaling my stop up, and I want to get out of the second half right here if I was trading it manually. But you can see you can use our tools to trade with the trend and counter trend very nicely. And basically, in a nutshell, you want to trade with a trend until it moves statistically too far. So what is too far? It's very easy with our software. Above the 2.0 band, and when this is at or above the plus 80 level, it's too far. It's likely to reverse. And this is one of the stronger trends, but you can see this area here, reversed. These 2 areas here, market kind of went sideways, drifted down. Up here, market drifted down. Right here, what did it do? It went down. Right here, what did it do? It kind of drifted down. Between the perfect oscillator plus 80 readings and the 2.0 band on the chart, when it's moved too far. And these are completely different statistical models that use completely different mathematical methods. They use different past statistical data to calculate it, but together they're just amazing. And one last thing I would say is too far is anytime a trend goes to or beyond the 1.618 fib target. Another method. So that would be anything at and above the 1.618 off of this first move here. This is too far. It's very likely to reverse, and of course it did. And then once it doesn't mean it's going to reverse the rest of the day, but it did reverse. So then you draw your next fib off the next wave. And because it's already gone up 1 wave, 2 waves is a 3rd wave, it didn't even make it to the 1.618. But again, it's above or upper containment band. And guess what? The market wasn't even at the 80 level up there. So this is kind of an example, and this is more of an advanced method, but divergence trading. When the market makes higher highs but lower lows on either the perfect oscillator or any of our histogram-based trading models, very likely to reverse. And the last but not least, when price hits the upper Bollinger Bands on here, tends to reverse. Especially when it's at an extreme above or upper band and at or near a fib target. Notice this right here. Right here, what did it do? Reversed. This one right here, what did it do? Reversed. The majority of the time, price does not say outside of the Bollinger Bands on this. So these are many ways to trade. You can use our tools as a predictive because most of the time breakouts after rectangle patterns work. Double tops, double bottoms on the currency index work. You have trend line breaks that also work. For instance, right here, the Swiss going up. It found resistance at the previous day's high, wasn't able to break out. Came at 6 o'clock, broke out to the downside. The euro is very strong at that time. So what do? You buy 6 o'clock the euro Swiss. This is a no-brainer. I don't understand how anybody can't make any kind of living they want with our software. You can see in this case the euro Swiss is above the hourly, and right when that one broke out, you also have kind of a breakout maybe 5 minutes beforehand on the actual chart itself. But even if you miss that, you got this nice, beautiful at 6 o'clock breakout that goes up 80 pips or so. So not much else to say. Just get our software and trade the way I say, and don't deviate it at all, and you should do well.